Hello. Welcome to the second session of this month's two-part webinar series entitled Creating a Roadmap for the Future. Today, we will discuss estate planning, preparing and protecting your future wishes. My name is Candace Nayland, and I'm Vice President Philanthropy at Parkinson Canada. Before we begin, there are a few items I'd like to go over. From coast to coast, we acknowledge the ancestral and unceded territories of Inuit, Métis, and First Nations peoples. And for some housekeeping, to access closed captioning, click on the CC Live Transcript button and then click on Show Subtitle. If you'd like to submit a question for our presenters, be sure to write it in the Q&A window. Please ask questions and make the most out of today's webinar. The chat window is there for you to say hello, which I see you've done, and talk amongst yourselves. Before we kick off the webinar, we are going to share a video message from our President and CEO, Karen Lee.
Over 100,000 Canadians live with Parkinson's. We have one of the highest rates in the world. My name is Karen Lee. I'm the CEO of Parkinson Canada. My late grandfather lived with Parkinson's disease, and I know very well the importance of family and how they have to come together to support one another, but most importantly, the person living with Parkinson's. That is why I am dedicated and committed to ensuring Parkinson Canada continues to empower those living with Parkinson's. Each year, our programs and services reach over 10,000 people. We are a community. We are here not only for the person living with Parkinson's, but their family, friends, and their care network to ensure we all continue to thrive. Our advocacy efforts are focused on raising the voices of people affected by Parkinson's. Our Parkinson Advisory Council is made up of people affected by Parkinson's from across the country. They bring a diverse background and experience, but most importantly, they provide me and the organization with advice on topics that are important to them and their community. As a scientist, I know the importance of investing in bold and novel ideas that lead to breakthrough discoveries. At the same time, bringing researchers, clinicians, and people living with Parkinson's to collaborate to push the needle in our understanding of Parkinson's disease. We invest in the next generation of researchers and clinicians to ensure that we continuously understand the Parkinson's disease and also the care management of people affected by Parkinson's. When I'm in the community, I want people to know that Parkinson Canada is with them in every step of their journey with Parkinson's disease. People often ask, when is the right time to connect with Parkinson Canada? Is it when they have their first diagnosis? Is it when their symptoms get worse? Or is it when they need more information and resources? The answer is now. Researchers and clinicians are working tirelessly to find a cure. Meanwhile, every single day, 25 more Canadians are diagnosed with Parkinson's. Our goal is to empower people affected by Parkinson's to live well now.
Now let's get started. The format of this webinar is a conversation with our expert panelists, Michael Morse and Malcolm Burrows. Malcolm is the head of Philanthropic Advisory Services at Scotia Wealth Management, which is the largest national service provider to private foundations and operator of Aqueduct, a public foundation with donor-advised funds. He spent 13 years with 3 Toronto charities, University of Toronto, Princess Margaret Hospital Foundation, and Sick Kids Foundation, a nationally known philanthropic advisor. Malcolm works with clients to plan, structure, and implement their philanthropy, especially through private foundations. More to come on this in our conversation. We are also joined today by Michael Morse, Senior Wealth Advisor, Portfolio Manager for Scotia Wealth Management. Michael has more than 27 years of experience in the financial services industry. Michael holds both the Chartered Investment Management designation and the Professional Financial Planning designation. Michael is committed to delivering a highly customized and personal approach to integrated wealth management. He has frequently appeared on television to provide market updates and financial planning commentary. A warm welcome to our speakers. Really fortunate to have you both here. Michael, I'd like to start my first question with you. I have the pleasure of knowing Michael as he is a champion for Parkinson Canada. He is one of our top fundraisers for our Growling Beaver Brevet. It's an annual cycling event with proceeds going to Parkinson Canada's research programs and services, which you heard in the video. As this is part 2 of Care Planning series that we launched last week, let's start with your connection to Parkinson's and what you've learned about the importance of planning for the future, in particular, when someone is impacted by Parkinson's.
Sure. Thank you, Candace. It's a pleasure to be here. I guess my time with Parkinson's started a number of years ago. My father was diagnosed and suffered from Parkinson's for the last 10 to 15 years of his life. And we were very fortunate that we had, my father was a doctor, my sister was a doctor. We had the resources to navigate some of his care. And while my sister was a doctor and was sort of the champion of a lot of his care, the sense that I got was that even with my sister's background in medicine, it was quite difficult to navigate the care and to navigate a lot of the resources that one needed to access as you were as a family going through the Parkinson's experience. So in the final year of my father's life, my wife and I funded a research grant in his name. And it was really nice. Just a few months before my father's passing, he actually was involved in selecting what the grant was. And it was funding some work that a neurologist here in Toronto was doing about helping people with Parkinson's today. And my dad really wanted to focus on helping people today live a better life with their current circumstances. And so that evolved in me beginning to do a little bit more work with this neurologist in helping some of the things that she was doing. Through that, I developed a relationship with Karen Lee, and she and I speak about a number of things. You and I have met that way, and I've now become involved actually in some work that Movement Disorder Society in the US is doing with some international research. So it's been really engaging for me to be a part of something so important. So I think that was the first part of your question. The second part of the question is probably a little bit more up my day-to-day, my real job, I guess you could say. And it's around the importance of planning and how that relates to Parkinson's. As an advisor, I'm a very big believer in taking a holistic approach to wealth and to planning for the future. And when I say that, I'm a big believer that people don't invest specifically for the sake of investing. There's a bigger picture reason why people do that. And every circumstance is unique. There are some very standard things around, retirement or education or planning for the next stage of life. But planning, as it relates to health, is something that you can't necessarily focus on the outset. You don't plan to have Parkinson's, or you don't plan to have cancer or whatever the disease may be. But it is very important to focus on what potential outcomes there may be. And as one is uh, comes down with such a diagnosis, refocus their planning and adjust to understand what does that mean and how does that relate, both from a financial perspective, but from a life perspective, and how do you integrate all of those things together?
Yeah, there's so much you can do about planning for what ifs. So can you tell us a little bit more about how you talk to clients about planning for those what if scenarios?
Well, that's a great question. I think, it's very difficult to plan specifically for a disease, but we do plan around, if somebody is healthy, we do plan for contingencies. We plan for circumstances that you may not expect. But I think in here, probably the most important thing to recognize is that planning is not a one-time event. Planning, life happens and things change. And planning, I love the analogy of a roadmap because I use that analogy a lot. Sometimes you have to take a detour and sometimes things happen. And it's really important to come back and evaluate, are the assumptions that we've made up until now still accurate?
Yeah.
What's changed and what do we have to do to adjust our thinking? And so I wouldn't say, one can plan for any contingency, but it's important that one is fluid in their thinking and continually sort of adaptive to the changing environment and what might be.
Yeah, we certainly heard that at last week's webinar in terms of when is the right time to consider changes in care. So it's very much when you're thinking about care, you're also thinking about estate planning, but it's really when the transition times happen, such as retirement, downsizing, life changes, and health outcomes as well, and health changes. So thank you for that. Because this is an estate planning session, why should a will be a critical component of planning?
So a will is an extension of one's planning. So all of the planning we've been speaking about right now is planning through one's life. And then through one's lifetime, there's active planning, and in the absence of one being able to act for themselves, there are powers of attorney that allow people to somebody to act on your behalf to make decisions when you're unable to. A will is simply an extension of the planning beyond your lifetime, because everything during your lifetime ceases to be on death. And so a will is simply a roadmap of what your wishes are for your assets or for your property beyond your lifetime. And with investments that people have, with real estate, in many cases, estates are larger than people sort of think about or expect when they're first thinking about it. And so it is very important to plan for that in an orderly manner so that your wishes are executed. There's no right or wrong answer, but it's to allow your plan to be acted upon.
Malcolm, just with Michael's comments here, we know that doing your estate plan, it's a very thoughtful process, and it takes a circle of your trusted advisors, your financial advisors, your friends, your family, your partner, to really be involved. Taking from last week's speaker and what Michael talked about in planning, when we're able to prepare for the future, we give the gift of peace. Can you also expand on the benefits of estate planning?
And that's a lovely way of putting it. Just by way of introduction, I come at the question of estate planning, or the whole act of estate planning, from my background as a charitable planner. But I focus a lot on this estate planning process. A lot of donations occur in wills and around people confronting and dealing with their own mortality. And I found that a couple of basic things sort of reappear again and again with the act of estate planning and the will, is that procrastination is very common. It's very, very common that I can't tell you as a professional, almost every one of my clients to some degree engages in some form of procrastination when it comes to their will. So I want to first and foremost say this is something that we share, and some people are far more sort of efficient about it. But there's this general process of we do get paralyzed by the what ifs and questions of balance, questions of process. Who do we speak to? How do we implement it? So having this circle around you, and just picking up on Michael's point about a holistic planning approach, is not everybody has that lawyer that they can go to, and so that becomes an impediment. But if you're starting, you work with a good investment or wealth advisor. That's very helpful. Resources, Parkinson Canada has a network and resources as well, family, friends. So starting to talk about it and not just bottling it up is absolutely essential. It's not just that professional network, it's also a social network and as well. The other thing is, I do want to reinforce, I think you're absolutely right, that the second thing about estate planning, once you get it done, there is an enormous peace of mind that follows. But there's so many practical hurdles to getting it done, but none are insurmountable. And so there's one of the things I often sort of approach estate planning, sort of looking at it before we get to the will, is looking at it in is a number of different sort of priorities. First is always think about it in terms of taking care of, first and foremost, your needs, the needs of your spouse. So you start with sort of your own needs, because often when you spring ahead to the estate planning process, you begin to think about sort of, there's other potential beneficiaries. First and foremost, take care of your own needs. And that relates to Michael's comments about power of attorney. Ensuring that you have a power of attorney in place, which is simply a legal document. It's a trust-like document that when you need assistance, you feel that you're no longer able to take care of your financial matters, that they're protected, you're supported. Those things are immensely important. And typically that's somebody in the family that's going to be able to support that. It could be a spouse, it could be a child, but there's other possible candidates. But it's ensuring that your financial care is taken care of. And that's particularly important in the context of if there's Parkinson's in the family. And second is, of course, the attorney for personal care, which is another trust-like document. And it's separate from financial matters, but it's typically done at the same time you're writing the will. Who do you want to make decisions about your care? This is an immensely personal question. Yeah. And it often, we often see that who will provide those care decisions and the support decisions may be different than the financial decisions. So back to this notion of we need a community of support. We need a group of experts to come around and provide help. So first and foremost, starting with your own needs. That's sort of the basis of planning, and it's not selfish, it's practical, and it's fundamental. The second point when you're looking at estate planning is then look at your what are the family needs? Who are your natural sort of beneficiaries? And in many cases, it's kids, could be grandkids, family. So thinking about sort of who that next generation is. But for others, there's friends, important people in their lives that have really contributed. Could be caregivers that they'd like to remember or acknowledge in some way. That's secondary after your own needs are taken care of. But that process, and as you go through the planning process, just begin to sort of write down sort of who are your primary beneficiaries. And it often helps to break this down into two categories. It's essentially this is very informal language, but who are your A-class beneficiaries, your primaries, and who are people that are important to you, that you love deeply, but just want to acknowledge. And that often breaks down in terms of different types of gifts. So typically primary beneficiaries are named in the residue of a will, while secondary beneficiaries are named as a recipient of a legacy or a specific bequest. What makes a specific bequest? Well, a specific bequest will be a specific amount of money. So I give $10,000 to fill in the blank, or it could be a personal effect, say a treasured family heirloom, or it could be a set of dishes or something like that. That's also part of the will, but it's an outright gift that your executor will distribute off the front end. And just sort of going through and drawing up a list of your beneficiaries in advance and figuring out, do they sit in the legacy category, which is the sort of the secondary group, or the primary group, which is typically the residual beneficiary. Now, the third category to look at when you're thinking about an estate is to think about, and I'm going to throw a bit of a jargony concept out, but an idea of social capital. And this idea is simply, in any estate, most of us look at, as said, sort of our immediate family, our immediate circle is those primary beneficiaries. But often we forget in the estate planning process that there's taxes at death. And it's not, in Canada, we don't have estate taxes, but we do have something known as the deemed disposition of property, taxable property at death, and that's capital property. It's property that has capital gain associated with it. So if you own, for example, stocks or bonds that have gone up in value, they will have been essentially, the government comes along and says, at your death or the death of the second spouse, all of those we're going to pretend they've been sold. They're deemed to be disposed, and there's a tax bill sort of that occurs just at the moment of death. So that's something to consider, but it also can include, if you're fortunate enough to have a cottage or a secondary property of something like that, any real estate that's not a primary residence, all of those are taxable. An RSP or a RIF is also deemed to be disposed of. So all of these things can create taxes at death. And the last sort of, so that social capital notion is, what are you giving to society? And when I mention taxes, of course, that's something that we must give. But in the Canadian system, we also have, Canada is unique in the world. We have the most supportive charitable incentive system in the world to encourage and support donations. And it's less on the everyday donations that most of us make. So it's not when you give $100, it's actually more around estates. So in the US, for example, 1 in 1,000 Americans who give to charity get any kind of tax savings. In Canada, everybody who gives to charity in their estate gets some form of tax savings. And you can entirely wipe out your taxes or eliminate them in most provinces if you give enough to charity. So I'm not suggesting that that's sort of an objective. It's just a choice that's built into our system. It's actually a saying that you have to give something to society. So looking at it in terms of, do you want to pay taxes, and that default, and taxes, of course, cover so many social priorities, health priorities in the country, but there's also this direct choice process that you can choose as part of the estate planning process to donate. And most people I find don't think about donating first and foremost for taxes, but understanding that it's part and parcel of the process. It starts with cause, it starts with those values and commitment and this deep belief in action. But what unlocks it really and makes it practical from an estate planning perspective as well as, and from a family balance perspective, is this idea of social capital and the taxes that unlock it. So you have to pay some, you have a choice in the Canadian system, and that's helpful. Go ahead, Candace.
Go for it. Actually, I was just saying there's a lot I've taken notes out of. There was a study by the Canadian Association of Gift Planners, basically just what you talked about, that a large proportion of Canadians actually view bequests as an either or. So I either leave a bequest to a charity or leave a bequest to my family. And what I just heard from you is there's benefits to doing both. So if you want to expand on, I think you were finishing your thought.
No, I think, no, thank you. That's a wonderful addition. And it's something that it's interesting. As I mentioned at the front end, I'm a lifelong charity person. And it's one of the things that we do have good incentives, and we do have a strong tradition of charitable giving in the country. But there's very little sort of public discussion about this balancing act and what tools are available to you, what sort of savings can exist. We tend to focus when we do wills, it tends to be a legal drafting process. Nobody talks about, oh, by the way, if you leave this amount to charity, your estate is going to save this much money. And so that really is an offsetting process. And as I said, some estates, if they, individuals through their estates, they can literally eliminate all taxes by giving to charity. So there's that personal choice aspect of it. And it's just being aware of that. And again, going back to the planning side of things and the need for a team. I've worked with Michael extensively, and being able to do that tax analysis, whether getting an accountant involved or working with a colleague to really assess that, it helps us make informed decisions, even though it first and foremost isn't a driver of those decisions. It's just understanding this balancing act. And that's really important. One of the interesting questions that sometimes comes up is because in most provinces in Canada, we actually encourage this notion, it's another bit of estate planning jargon, of testamentary freedom. And testamentary freedom really just means you can give your estate to pretty much anyone you wish. So there's family law rules that are province by province, and that ensures that spouses and dependent children also have a claim. It's very, and that's quite understandable. I mean, this is something, it's actually only been in our system about 50 years. There used to be an Old Dependents Relief Act, which was far less progressive, but at this point, spouses share property for the most part, and it's only dependent children that have a claim. So there's really a choice to choose. The vast majority of people, of course, are making choices based on their primary family. But sometimes there's that balancing act. They look at, I know in my own family, having one of the nephews with a disability, you end up saying, where do you need resources? And in order to be equitable, in order to be supportive, how do we, it doesn't mean that everybody gets the same amount. And those are some tough questions that can lead to procrastination and paralysis at times in the process, but that you need to go through them. So I often focus on the first priority, because you can be back to this theme of being overwhelmed.
Yeah,
is start that process. And I think I completely agree with the earlier comments about updating wills. It happens at major life changes. If you birth, deaths, marriages, retirements, those sorts of things, change in health. These are times to update will. And it's ideal to sort of establish get a relationship with a lawyer. Not everybody uses a lawyer, and we can come back to that later on, but lawyers have the expertise and can really provide and sort of go through that process and help guide you. And it's a keystone document, and they'll also help you with things like power of attorney, attorney for personal care as well. It's ultimately all a package and asks you about many of the basic questions. And I'm talking about tax, I'm talking about sort of some of these other considerations. The first, I can't emphasize enough, engage in the process. Don't talk to that lawyer. The lawyer will guide you through it. In our world at Scotia Wealth, we have estate planners. They help sit down, they unpack it, and sort of bridge the process. But the act of engaging in the process is the most important thing. Most people can't sort out all of the issues and all of the implications that are related to a will solo. So just that would be my sort of call to action. The other thing that I wanted to just sort of pick up on as well is this idea, and Candace, I love this, you sort of calling it out, this common perception that when a charitable donation, a gift by will or an estate donation is included in a will, it's, as you said, it's often perceived to be disinheriting family. And I do want to emphasize and loop back in this concept of social capital and the tax savings. The only entity that's in a sense being disinherited, and that's by design in the Canadian Income Tax Act, is actually CRA essentially. So, and in many cases, in some estates, actually, the tax savings may even be slightly greater than what would be paid overall. So there even may be a slight tax savings, marginal, but greater by giving to charity. The other thing that's important is one of the things that I've been involved with over the years is a lot of tax policy development. So speaking and working with government to encourage them to improve incentives for charitable giving, because it's so essential, particularly for you look at our healthcare system. I mean, it's there's many great things about it, also struggles, but it doesn't pay for research. It doesn't, to the same degree, pay for that community care. It doesn't pay for the education in the same way. And so organizations like Parkinson Canada really are filling in these gaps and sort of driving that future. And that's and it's one of the reasons why really advocating for another form of public funding. But a gift by will, for example, can just be a simple matter of I give 10,000 to Parkinson Canada, I give 25,000 to, that's a legacy. But it could also talk to and make sure when you're talking to your lawyer is, can you, if you own stocks or mutual funds or ETFs or something like that that have gone up in value, collectively these are known as public securities. If you donate or transfer, your state transfers public securities to a registered charity, you actually get an additional tax saving, because typically there's a capital gains tax owing on those securities, and that's eliminated. You don't have to pay capital gains if you transfer securities rather than cash. So another way of putting it is that you get two tax savings rather than just one. Because normally you just get one, you get a tax receipt and it turns into a tax credit. And it's tax time of year. So you'll see that in part on your taxes when they're claimed or when they're prepared. But if you donate public securities, you get two savings. And the whole point here is to both unlock some of these resources, these investments or this wealth that has been built up over time to provide a public benefit. And it also can significantly reduce the tax bill, both during life, if you're giving on an annual basis, or even in your will. So these are things to think about and have a conversation with the lawyer about, but back to the team theme, it's also making sure that it's flagged and understood if you have an investment advisor or something like that. So
those are all really great commentary and really great expert advice from you. Having been a nonprofit for a very long time, I have seen gifts and wills come to us as the charity beneficiary. And it's certainly saddening sometimes because we didn't get to know this individual. So maybe, Michael, I'll have you comment. Why is it important to let the charity know about your will provision? And maybe either of you can both give an example on why the importance of letting the charity know about your provisions.
Sure, I'll share a couple of things, and then I'll turn it over to Malcolm for some comments on that. But I think, like as Malcolm's discussed, it is important when you make, sometimes these are, if it's a will, hopefully it's a longer time in the future. And, whether it's a fixed amount or whether it is a percentage, so it's a number that the charity gets. Often, if it's made out of a will, it's a larger donation than would otherwise be received if it was done on an annual basis. And depending on the size of the organization, they need to be prepared for that, number one. It's important for them to know your wishes, because many charities, while they appreciate receiving the donation, they also want to respect and honor the wishes of the donor. And so it's important that the charity understand what the philosophy and the thought process was behind the donation, so that they can do the best, to the best of their ability, honor and make sure they respect the wishes of the donor. Malcolm, I think you've probably got far greater insight into that question.
No, those are wonderful comments, Michael. I agree. I mean, I often put it in the context. I wrote a sort of over the years, I've noticed that about 1 in 10 Canadians that leave money in a will to charity actually inform the charity. And partly I think that this is defined by, we think of the same, a similar statistic, perhaps not nearly as high, but often culturally we perceive a will as entirely private. We don't want to, so we don't disclose. I mean, it's best practice in the estate planning world to talk to your own family beneficiaries, talk about what you own, talk about decisions to make. But the number of families that consistently do this are still probably in the minority. And there's often a sense that in sharing this information, you feel a bit vulnerable. And that's true with charities as well. It's naturally viewed as sort of confidential or private information. But I really want to reinforce Michael's point, is that you need to figure out which charity you do it with. And if you have a long-term, strong relationship with them, it's more than just a legal or financial transaction. It's community-based. It's important to know, and it's helpful from a planning perspective. And it's no lawyer will say this. Well, actually, that's not true. Great lawyers will say this, but there's a real joy in connecting with charities, knowing what they're doing, knowing what their plans, their priorities, and that planning process, the engagement process. Joy is not something that's typically put at the top of the list in planning, but it is important. It's human. It's an act of optimism. It's an act of faith, and that sort of connecting is to me very, very important. But I do understand why people have a certain amount of reticence sometimes.
It's true. I do want to leave time for audience Q&A, but there are a couple of questions that I want to direct to you, Michael. And again, this is back to planning your holistic approach to wealth. When do we involve the younger generation? And is such a thing as too early to engage them?
I think there's no right or wrong answer to that. I think it really depends on family circumstances. It depends on openness and your comfort with talking about wealth, and it also depends on the degree of wealth. I have lots of conversations with clients about the trade-off between wanting people wanting to see their kids enjoy wealth today and to be able to share and experience that wealth with their kids today when they know they need it or when they need it more, versus the trade-off of people wanting to make their kids independent and to have their kids not feel entitled and not know that there's something for them to rely on. And so there's no right or wrong answer to that. However, I would say communication is really important. I came from a family where my father was a doctor and did lots of counseling. And I've come to respect a lot of the communication that he was big on as we were growing up, although at the time I don't think I recognized it as much. But when you talk about involving the younger generation, I would also extend that to a will and planning itself. And that at a certain point, families, depending on the complexity of a will have their children, who are often the beneficiaries of their will, become the executors. And if that's the case, it's very important to talk about wishes and to talk about what your plans are, because being an executor is a lot of responsibility. And so I'm a big believer in client relationships. I'm a big believer in communication. I facilitate some family meetings where people talk about wealth as a family. There's no right or wrong answer again, but I would say more communication is likely better than less from my perspective.
You talked about the role of an executor. Maybe comment on who should you choose, and should we consider naming more than one?
Again, and Malcolm, I will, I guess, look to you for your comments as well. But I would say a will is a very personal thing, and there are lots of options. You can, as I say, some people choose grown children. Some people will choose a close family friend. Although being an executor can be a lot of work, and sometimes it can be a big burden to be asked to be an executor. As people age, it is often a consideration to choose an executor who is younger, because if you choose a friend who's an executor, as you get older, they're aging at the same pace. And so sometimes, that's more complicated for them to become an executor. And where there's a lot of complexity, I'm a big believer in having a corporate executor and engaging a trust company to begin to use or to help with the executor process.
Oh, that's great. I know you've asked Malcolm to comment, but I do want to get through 3 questions from our attendees. So one of them, if we could actually, if we can answer this, I'll read it out. If my children are my legal inheritors and executors of my possessions, do my children's spouse automatically become the legal inheritors of my possessions in the event my children are deceased?
Yes, it's the long and the short of it. So because of family law, it's a gift to your children, and if they're married, that becomes the property of the couple. And it can be kept separate to some extent, but it can't be kept entirely separate if it passes to a child who is married. There are ways of structuring, because there may be concerns for whatever reason about relationships, marriages do fail, and there can be concerns around that and complexities. Occasionally trusts are used in situations like this, where property is put into trust, for example, to skip a generation and take care of grandchildren. It could be to take care of the individual. And so it's separating out that money so it doesn't come fully into the spousal property. So there's not an automatic trigger. Now, this is an area that requires legal counsel, and I'm just giving a very general description at this point.
That's great. Thank you. The second question we received: we recently became grandparents. Congratulations. The baby's other grandparents created a registered educational fund for the baby. It is our understanding that a child can only have one of these accounts in their name. How can we contribute to her fund and still obtain the tax credit? It's quite technical.
So I'll answer that. It's a child can have multiple RESPs. It's all based on SIN number, but the grant is based on the SIN number. So you are only allowed so much, whether it's across multiple plans or one plan. So I would suggest, I always advise parents or grandparents to let the parents set up the RESP and to just give money to the parents to contribute to the RESP. The grant is basically the government will grant up to 20% or match up to 20% of the first $2,500 donated every year. It's a great question. I've seen parents or grandparents get in trouble with this where they contribute too much because they both do it unbeknownst to the other. But there is a maximum annual amount that can be contributed.
And just to be clear, there's no tax credits for contributions. The funds themselves, the RESP funds, are tax exempt until they're used and distributed for educational purposes. And as Michael mentioned, there's a government grant of up to 20%. So it's actually granted, and there's no, it's really just goodwill, and they're funded with after-tax dollars, whether they come from parents or grandparents. So.
Thanks, Malcolm. That's a great point.
Yes. So I know our audience are just energized now to start their future planning. Maybe you can comment on, where do they start? What resources are available?
I'm happy to start. I think Malcolm said it best when he said procrastination is something that happens to everyone. And I would just start by identifying what's important. The other thing that I would say is do not feel that you have to plan for the rest of your life is hopefully a long time. And don't feel that this is a plan that you're planning, for 20 or 30 years out. This is a document that gets reviewed and revised over time. And so you make a plan today based on your circumstances, your thoughts, and your wishes today. But the one thing that I can guarantee is life happens and things change. And what was important to you today, or what is important to you today, may or may not, in fact, be important to you 5 years from now. And so I would say, begin to think about what's important, write some of those things down, speak to people. I'm very biased. I am a wealth advisor. I speak to people about this all the time. It's what I do. But speak, use whoever is a trusted resource, whether, as Malcolm mentioned, it's an advisor, a lawyer, it doesn't matter. Just begin to lay things out and recognize that nothing's set in stone, that things change, and you'll come back to this.
And as I mentioned earlier, just getting to the will drafting is important. Find that lawyer. And not every lawyer drafts wills, but most, smaller firms do. There's also, if you have a more complex estate, there's larger firms that are specialists that bring into account the tax side of things, trusts, and those sorts of issues. I mentioned briefly as well, often in professional settings, we don't talk about other resources, but just picking up on Michael, I'm putting words in your mouth here, but sometimes we shouldn't let the perfect be the enemy of the good. And because things do indeed change, and it's far better to act and get something in place. There are a lot of resources, increasingly online, where there's precedent wills, and there's will services that have developed. So I'm not suggesting that in a very simple will situation, these may be serviceable. They may, in some cases, just be a temporary solution, but it is something that in some cases is worth considering because it's like so much of other things online, but it's really important to know that the laws of the province of your residence will end up determining whether it's probate, whether it's taxation. Even I mentioned concepts like testamentary freedom. It's different in BC than it is in Ontario, than it is in New Brunswick. So just being aware that you have to have resources, Canadian resources, and resources that are aligned with the provinces. But increasingly, this is an area that it's changing. And some people are going that route, particularly when they're younger and just want a peace of mind, but don't have necessarily a huge amount of property or huge amount of complexity in their affairs. So.
I actually want to just add on, in case our audience aren't aware, we here at Parkinson Canada, we developed a will planning guide. So please reach out to us because that is a great resource if you want to get started. I also see here, I know we're running out of time, but I see that we have about a couple questions. We'd love to get back to you. We'll send an email and get back to you individually. But as always, I want to thank everyone for asking such great questions and our presenters for your thoughtful responses. Thank you for attending today's webinar. Special thank you, Michael and Malcolm, for joining us to discuss estate planning. In about a week's time, we'll send everyone an email with the link of the recording and any resources mentioned here today. Next month's webinar is on sexuality, intimacy, and Parkinson's. It takes place on Tuesday, April 11th on World Parkinson's Day, and it's from 3 to 4 Eastern. Watch your email inboxes for more details, and a registration link will follow. On behalf of all of us at Parkinson Canada, I'd like to thank you for joining us, and I hope you enjoy the rest of your day. See you next month.